In this video, we're going to go into what my view is of a liquidity trap and its key characteristics. Then we're going to jump into a couple of chart examples. Then stay tuned till the end and I'll provide you with some resources from other traders on their views on liquidity traps. Let's do it. Right, so what we've got here is a stock that ran back in February. INBS was a recent reverse split, which always helps as it's a lower float, means that less buying is required in order to move the stock's price. Now, this setup to me is a liquidity trap. It could also be classified as a first green day bounce. But trading is far more of an art than it is a science. So often things do overlap, and it's not really an exact sort of thing. Each sort of liquidity trap will look different, and there will be, as I say, some overlaps. So what we see here is a big day one. A big day one. What do I mean by big day one? Huge move with big volume. Okay, so this is like a 200% move with 95 million shares traded. So a lot of shares changing hands, a lot of float rotated many times, and a lot of new buyers coming into the stock. So after day one, what we want to see for a potential liquidity trap is a fade. Can be 1 day, can be 2 days, can be 3, can be many, but crucially there needs to be a big decline in the volume. So here we can see there's more or less a 90% drop off in volume, which is pretty much perfect. Then we see a little bit of consolidation, stocks start to grind up, volume come back in, retest former highs, and possibly break out. Okay, now this is a liquidity trap day here. Granted, it did have earnings, which sort of acted as a catalyst for the liquidity trap, but it doesn't necessarily have to have that. So I'm going to jump into the intraday chart just so we can see exactly how that played out minute by minute. So this is the big day one. You can see down here big volume, big move, 240, high of 7. Okay. Day 2, huge drop off in volume. Day 3, day 4, day 5, huge drop off in volume. Now, what causes the liquidity trap is that drop in volume, because on this day you'll have a lot of shorts getting involved. You have shorts getting involved all over the place, really, here. And what happens is people size according to the amount of liquidity on the day. So this stock traded 95 million shares. So people can take pretty big size there with and get in and out relatively easily. However, what happens on these days as the stock falls in price is the volume drops so significantly that shorts can't get out without affecting the price of the stock. They'll push the stock higher if they've looking to get out quite big size, because like I say, the liquidity is just not there. Then what we tend to see with a liquidity trap is some sort of consolidation, reclaim of VWAP, and it begins to grind up. Now in this instance, shorts, that shorted up here are sitting, relatively comfortable, but the grind up still does indicate that the momentum may have changed, and we might be looking at a possible reversal here. So then we see earnings released, volume begins to come back in. When the market opens, things really begin to heat up. So you'll still have some shorting here and here and here, and as these levels begin to be tested and break, shorts begin covering, and this along with dip buyers, but it's the shorts that are panicking, needing to get out obviously having to buy to cover, forcing the stock price higher and higher. Most shorts, I'm guessing, will have a final risk of this high of day. So when that begins to test and break, even more volume comes in because that's the final shorts having to get out. And it's all these shorts covering which really cause this short squeeze. Yeah, I hope that makes sense. I'm going to give you another example, slightly different, and more recently with ASST. Dawson in the chat did a really good sort of his take on this in his watch list, and it sort of played out to a T really. So ASST, like I say, INBS could be categorized as a first green day bounce. ASST could be categorized as a third day surge, but also they are types of liquidity trap. So here again, if we look on the daily chart on the 26th of August, we have this big day one move, like 130%, something like that. Big volume, like 107 million shares traded. Day two, it holds its gains this time. It did give back quite a substantial portion on the day, like a 20% move retracement, but the next day it sort of holds its gains. But crucially, again, we can see down here huge drop off in volume, only 3.5 million shares traded. That's day two. Day three, we see the volume come back in, retest former highs and push, so the squeeze is on. If we jump into the intraday. Okay, so we have this big day one. Okay, lots of traders. I think this was a relatively low float as well. So float rotation means there's lots of new retail traders in the stock. Whereas, if it's a big cap, you're going to have people, you don't really get these kind of moves because a lot of people aren't fresh in the stock. They'll be holding from different, completely different time periods. So float rotation and a low float is pretty important, very important for this setup, I would suggest. So yeah, on this day one, you can have shorts get involved all over the place really, and again they're going to size in according to the liquidity on the day. On day two, I'm guessing shorts were sweating a bit here when it began to grind up. You'll have shorts who were in here, probably shorts trying to short the breakdown as well. So when it does start to grind up, they would have been a bit uneasy, but then it fades the next day. So it's possible some of them would have felt, as Dawson said in the chat, that they kind of survived the worst of it. But then we see day three, we see it sort of break over this key level of 2 and hold. So at this point, shorts are going to be starting to sweat. Starting to become uncomfortable. The stock's not breaking down. They've not had the liquidity to exit their positions, and when the price begins to go up, the covers begin to come in, and it starts to squeeze, and that's what we see. So I hope that makes sense. Two examples of a liquidity trap. They don't have to squeeze. They don't have to play out like this just because there's a big drop in volume. But this is what we're sort of looking for in terms of how a liquidity trap does form. Okay, cool. To recap, for liquidity trap, what we have is a big day one with huge volume. Day 2, 3, 4, 5, or however long it takes. The following days, it has a huge drop off in volume, up to 90% drop off in the volume. This is what causes the liquidity trap because the shorts who entered on day one can't get out. So we need that big drop off in volume. Then we see some sort of price consolidation, then a bit of a grind higher. Then we see shorts coming in to cover their positions. Cool. Hope that helps. Any questions, you can pop them in the comments. Cheers. Right, guys, that's it. Just a couple of additional resources for you. First, there's a link in the description of a blog post. I'm not sure who's it written by, but it often gets passed around in the chat room, in Roland Wolf's chat room, when people ask what a liquidity trap is. So I'd recommend reading that. And also, I'm going to link a YouTube video by Chris from Investors Underground on liquidity traps. Absolutely brilliant video. Highly recommend watching that. I certainly learned a lot from it. Okay, cheers. See you on the next one.